everyone, and thank you for joining us once again here at Seafried and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this briefing, we want to review over the Fed release from this past week in January 2020, as well as that initial estimate of the fourth quarter GDP growth rate, look at some inflation numbers, and then follow that up with some unemployment chart for the states and the overall coincident index released by the Philly Fed for December. So overall, when we look at the Fed release, we can see that the Fed's language remained fairly similar to where it's been over the past couple of meetings here. They continue to say that the market remains strong and that the economic activity has been rising at a moderate rate. We continue to see that happen, that moderate rate language in there, and we'll see that in the GDP release. But although household spending has been rising at a moderate pace, this is a little bit different than what we've seen before. In previous releases, they've commented that the housing spending has been strong, and now they've backed off a little bit to that moderate pace. And business fixed investment and exports, though, remain weak, and we will see that in the release. So overall, we continue to see the Fed in the stance of holding where they are in terms of rates. They do not anticipate changing rates probably over the next couple of meetings. So when we look at the economic expansion that we're currently in, we are now at 126 months. We're at that longest. We continue to extend that record. Now, overall, when we look at the GDP for the fourth quarter, this is the advanced estimate, 2.1%. We beat estimates by that 0.1%, so stronger than expected. But when we break it down into the various categories here, we can see some softness occurring in that consumer segment. We look at the breakup. Consumers made up 120 basis points of that overall growth rate, down from where we were last quarter when it contributed 212. Now, when we look at the growth of that individual category, we can see that the growth slowed to 1.8% from where it was in the third quarter at 3.2%. So we see this slowdown in that growth rate overall in the consumer spending. Now, when we take into consideration that consumer spending makes up about 66% of the overall economy, that is a little concerning, and hopefully we will see that bump up in the first quarter. But if we continue to see that slowdown, that would be an indication that our GDP growth rates are going to continually come down. When we look at the investment portion, that detracted 108 basis points from that growth rate, and that is because we saw the inventories decline, and that subtracted 109 basis points. We saw a significant reduction in inventories in the fourth quarter. Now, of course, residential fixed investments continue to be strong. They grew by 5.8% over the quarter. That's the second quarterly growth rate that we've seen in the past 8 quarters. So prior to last quarter, when we saw that growth rate start to spike up, we had negative growth rate in that residential fixed investments for 6 quarters. So that is a positive, and that a lot of that is that interest rate for those mortgages being so low, spurring on that growth. But the business investments, unfortunately, continue to decline, with the non-residential decline by 1.5%. So overall, detracting from the growth in the GDP by that 108 basis points. Government continues to grow, contributing 47 basis points this quarter, And then the big one down here, exports, imports, that net contributing 148 basis points to the overall GDP growth. This occurred because we saw a pretty significant reduction of 8.7% of imports. So we saw that trade relation, the trade wars having its impact here on the positive, with imports coming down by 8.7%. Conversely, we saw an increase in exports of 1.4%. So that was a positive, a net in tune of 148 basis points, contributing the most in the four categories here. In terms of inflation, we saw the price index increase by just 1.4%, below estimates of 1.8%. So we see that inflation not being as strong, and we saw the same occurrence on that core price changes. 1.6% was the survey. The actual came out at 1.3. So we see the inflation really continue to be subdued in here. In terms of unemployment rates state to state, it was interesting. We have 12 of these red states that are significantly higher than the U.S. average unemployment rate. So it's a new type of a trend that we're starting to see, is these increases in unemployment rates. Now, when we look at the Philly Fed Coincident Index, what we can notice is that we have now a total of 8 states that are red, showing negative growth rates in terms of the state GDPs. When we look at states across the United States, we still, however, have 39 states that are positive. But we want to continue to keep an eye on the states that are turning red. Once we hit like a 10 mark, that's an indication that we need to monitor this closely. When we hit 15, that is a broader scope that the economy in and of itself is slowing down at a faster pace. But overall, when we look at the 3-month change on average for the U.S., we're at 0.64%, down from where we were in November at 0.76. So we do see the slowdown, and when we look on average for the years, notice the continual decline. There's only one in 2018 when we had an uptick there of 0.03%, from 0.73 to 0.76, and now in 2019 that the numbers are all in down to 0.7. So overall, we continue to see that slow growth rate, and even getting slower in the GDP across the different states. That's what we have for you this week. We look forward to talking with you next week, when we will go over the performance of the Community Bank Benchmark Group and how it fared for the fourth quarter in 2019 and the entire year of 2019. Have a great week, everyone.